Welcome to the lecture on real options. So in this slide deck, we're going to see a few things over and over again. We're going to see that real options become important when these two ingredients are involved. First, there has to be uncertainty about how good a project is going to be. Sometimes it'll be good, sometimes it'll be bad. We don't know at the beginning. The second ingredient is that the project can be changed drastically when that uncertainty gets realized. So you do something different if things turn out good than if things turn out badly, right? You make different decisions in these two states of the world, and that creates a lot of value. That gives you, that flexibility has a potential to create a lot of value for your project. With these two ingredients in mind, the way we're going to solve these problems is to lay out decision trees. We've got uncertainty, so things could be good, things could be bad. We want to lay out each of those scenarios and see what we will do in every state of the world that we can think through. Okay. With the tree in hand, we'll be able to walk backwards through the tree to decide if it's a good project at the very beginning. Okay, so we don't know how things are going to shake out. We're going to draw a tree of all the possible outcomes. We're going to think through our decisions in each possible outcome. And then with that, we can walk back to the present and decide if it's a good deal or not. Okay. So in words, what we're trying to get at with real options is what happens if a project can be changed significantly in the future. So this happens all the time if the investment can be ramped up, for example, if things look good and you ramp up the investment, or maybe you shut things down if things look bad, right? That's a substantial change in the project that depends on how things end up shaking out. Or alternatively, you can delay the investment. Maybe you don't have to invest right away. You can wait a little bit, see how things look. Okay, these are very different scenarios than what we have considered so far. So for example, this shows up a lot with oil companies and pharmaceutical companies. They're always doing a little bit of research to begin with. They don't kind of pick a plan and say, you know, an oil company doesn't say, I'm going to drill right here, right now, and they don't just commit to that right from the get-go. Right? They do extensive exploration, and then they decide where to drill and how to do it. And maybe they delay that decision. Maybe they wait to see what the price of oil is going to be. Maybe they change their decision based on what happens to the price of oil. Right? That's a very volatile contract there, how much they can sell the oil for. So because it's so volatile, that affects their decision. Likewise with pharmaceuticals. Again, they don't blindly go into the FDA trial for every new drug that they conceive of. They do R&D along the way, and then if things look good, then they go through the more expensive later stages of the project and bring the drug to a market. Okay, but the point is, the project is changing a lot depending on what kind of information these companies are getting as they go. So the DCF method is not very suitable in these situations. The uncertainty is too great, and you don't really have one fixed plan that you're going to stick to. You're going to change your plans depending on how the uncertainty is resolved. A real options model is going to be more appropriate, and then it's going to account for that uncertainty and the flexibility that we want to build into the valuation model. So fleshing that out a bit more, what's the problem with DCF that we've done so far? If you think about the case study, if you think about Mercury, we're forecasting the cash flows kind of as best as we can, but we're assuming that the company's going to stay basically the same. We're assuming that the projects are going to be basically the same no matter what happens. Again, maybe we do some sensitivity analysis or whatever to see how much the cash flows can go up or down by tweaking the parameters of our model, but for the most part, the project stays the same. Okay. That's obviously not going to be the case in all situations. Similarly, we've assumed that the managers who are running the project, the middle managers, we're not really trusting them very much. We're going to assume that the plan is the same and that the manager doesn't have discretion. The manager is not going to change things too much depending on how things shake out. But in reality, managers are often trusted to make these big decisions, and projects allow for some flexibility in that decision making. Okay, and that can create value, right? If you have kind kind of talented managers working for you, that's a good thing. That can create value for the company. Why? Because they have flexibility to change things, and you don't have to set down a plan from time zero as to what exactly is going to happen. Okay? That's how we were viewing things before. It's like we give the managers instructions and they're just going to follow them blindly. But really, that's not how it works. We need to have some flexibility in the project. So final bullet point, this ability to make the strategic choices during the project's life looks like an option. Essentially, the manager can decide, I'm going to buy more of this project, I'm going to ramp it up, or I'm going to get out, I'm going to sell the project and kind of walk away from it. Okay. So that's going to look like an option.
Look, man, I've got certain information, all right? Certain things have come to light, and, you know, has it ever occurred to you that instead of, you know, running around blaming me, it could be a lot more complex? I mean, it's not just, it might not be just such a simple, you know?
What in God's holy name are you blathering about?
Well, I'll tell you what I'm blathering about. I've got information, man.
Just like the dude here, new information comes to light, and maybe that means we have to change our plan. Okay, that's his point, that's our point. Same thing in finance. Let's go through an example just to flesh this out a bit more. Do kind of a very simple, very stylized example just to fix ideas. So we've mentioned oil already. We know that the price of oil is very volatile. So let's do an example where that becomes the central piece of the puzzle. In this example, you're considering purchasing a field which contains 10 million barrels of oil. Okay, just kind of making a very trivial example here. For simplicity, we're going to abstract away from all the technical details of the oil market. We're just going to say that you can instantly drill, extract, and sell the oil. So if you decide to, you can pull out that 10 million barrels of oil right away and sell it for whatever the price of oil is. Okay, so obviously very stylized, but just to fix ideas here. If you want to drill and extract the oil, it will cost you $500 million. How does the value of the field vary with the price of oil? And then how much would you be willing to pay for the field? Okay. So let's pull up the whiteboard here. Okay. So if there's 10 million barrels of oil and you drill and extract it, what's going to be the cash flow? The cash flow from drilling and extracting the oil. Well, you're going to get 10 million barrels out, and you're going to sell that for whatever the price of oil happens to be. So that will be your revenue. You know, the price of oil kind of per barrel, and you have 10 million barrels. Your cost will be the extraction, the drilling and extraction expense, which is labeled here at $500 million. So suppose the price of oil is $20 per barrel. Just call that P is $20 per barrel. What's the cash flow going to be? It's going to be the 10 million times $20 per barrel minus $500 million cost of extraction. So that's going to be a minus $300 million. Okay, obviously this would be a very bad deal. Buying the field and drilling the oil out when the price is $20 doesn't make a lot of sense. More generally, though, we see that there's this linear relationship. Right? We spelled it out here. The cash flow that you're getting goes up 1-for-1 with the price of oil. So you can just draw that out. You can see if the price of oil is $20, like we figured out, what's going to be the cash flow from drilling? It's going to be minus 300, right? You go up, and obviously as the price goes up, that field generates more cash flow when you drill. What's the break-even point? This is a good chance to practice our what-if analysis, and when we learned about the break-even point. So let's set the cash flow to 0. Right? That would be the break-even. When do we cross even? At what price of oil do we start to generate a positive cash flow? we'll solve for P here, which is setting the cash flow to 0. So the P is going to equal, there we go, 500 divided by the 10 million barrels. $500 million cost of extraction divided by the 10 million barrels. So the break-even point should be about $50 per barrel. Okay, so that's pretty intuitive. And that's where we have this red line drawn in the figure. At $50 per barrel, we're crossing 0. And so if things are above $50, then you can make money from drilling and selling. If things are below $50, you would lose money. In the past, how would we value a field like this? Okay, so how much does the value of the field vary with the price of oil? We've laid that out here. We've drawn out the figure. How much would you pay for this field? Well, that depends on what the price of oil is going to be, what you expect the price of oil is going to be. What have we done in the past? We calculate the expected price of oil, and we use that to get the expected cash flow. Okay, so suppose, so this is the break-even point. I'll write that and move that. How to value the field? We calculate the expected price of oil, and we use that to generate the cash flow. Suppose that the price is going to be $20 per barrel with a probability, say, 50%, just to keep things kind of straightforward. Okay. That means we'll generate a cash flow of minus $300 million half the time. Okay. Suppose there's another outcome. Suppose that the price is like $100 per barrel with probability 50% as well. Okay, so we just have two outcomes. If the price is 100, then what's happening is we're selling 10 million barrels at $100 per barrel, and then we subtract off the cost of extraction. So that's going to give us a positive $500 million from this field. Okay, so how would we value this thing? In the past, we would say, well, the expected cash flow is going to be 50% of the time you get minus 300, and then 50% of the time you get the positive 500. So in expectation, you're just taking the average here. You're getting, on average, $100 million from this field, right? If these are the two outcomes that you think are going to happen, then in expectation, the cash flow will be 100. Okay. That's what we've done. What we need to think about a little bit harder today with real options is the following question. Would you really drill if the price is $20 per barrel? Okay. I'm making a decision today about whether to buy this field. Maybe the price is 20, maybe the price is 100 in the future. But are you going to kind of blindly drill if the price turns out to be $20 per barrel? Probably not if you can help it, because you know that drilling here is going to generate a big negative cash flow. So in reality, what should this picture look like if you have some flexibility to change your plan as a result of the price of oil? The picture should look like this. When the price is below the break-even point, you don't drill. So what is the cash flow from that? It's just zero, right? You don't sell the oil, you don't extract it, so you don't get any revenues, but you also don't have to pay that $500 million cost, that extraction cost of 500. So you're just left with zero. And zero is a lot better than a negative number, right? All of these negative cash flows here, we don't like those at all. We would rather get rid of those and just replace them with zero. Okay, so if you have flexibility, that's exactly what you would do. You don't drill, you replace the negative cash flows with zero, and then you keep the upside. So you still drill when the price of oil is above 50, but you just don't do it when the price is below. Okay, so you see we have these two ingredients that I talked about in the very first slide. We have uncertainty as to what's going to happen. We have uncertainty as to the price of oil. That's the first ingredient. And then second, you change what you do depending on how that uncertainty gets resolved. So if the price is too low, you don't drill. That's a separate action than if the price is high, then you do drill. Okay. So this picture, if you've taken an investment class, this looks like a call option. yeah, that's not important for us, but that's where these kind of options show up in finance quite a bit. The value of the field gets it's nonlinear, right? It has this kink at the break-even point. You get a zero cash flow up until the break-even point, and then you get a linear payoff, a positive linear payoff going forward. That's going to help us increase the NPV of this field dramatically, because as I said, you're reducing the negative outcomes. You're reducing all those bad cash flows, all the negative cash flows, and you're just replacing them with zero. So that's going to raise the average valuation. Okay. So if I think about these two outcomes that we had before, suppose the price is going to be $20 with probability 50% and $100 with probability 50%. Well, if the price of oil is 20, you don't have negative $300 million anymore. You replace that with a zero. Zero is a lot better than 300. You keep the $500 million when the price is high. And so what's the expected value from the field? Well, you replace that negative 300 with just a zero, and you're left with 250. The value of the field went up by 150 because you were able to avoid the very bad outcomes. A related point is that even if the price of oil is low, even if the price is say $20 over here, you still may be willing to pay a positive amount for this field. So why would that be? Well, the price is 20 today, but maybe it goes up in the future, right? You still have an option to drill later if the price increases. And that option is valuable, right? You still have a claim to get these positive cash flows if things look better at some point in the future. Okay. So the value of the land is still positive, even if the price is currently below the break-even point. And in fact, that brings us to a kind of more subtle, interesting point, is that volatility here has an effect on the price of the field. So volatility is how much the price of oil moves, right? That would be the volatility of the price of oil. How much do you expect it to move? Is that a good thing or a bad thing? Do we like volatility or do we not like volatility? Kind of your maybe visceral sense is that you don't like volatility. You don't like the uncertainty because it's, who knows what's going to happen. It's hard to deal with that. But in fact, with options, you like volatility because with volatility, you get more of this upside and the downside is limited. Okay, so again, suppose that the price of oil is $20. Well, if it stays at 20, then the field is worth nothing, right? So that's a bad thing for you. But if the price is volatile and it can move a lot, then maybe it could move to 100, and then you can get a big positive payout there. Okay, so volatility is a good thing. And even if, say, the price is $60, so if the price is 60, then the field has some value. Volatility is still good here, though, because the volatility is asymmetric. It has an asymmetric effect on your cash flows. If things end up getting worse, well, the worst it can go is zero, right? There's a bound here. It can only go so bad before you just don't drill and you get a cash flow of zero. On the upside, though, things just increase forever. So volatility on the upside is very good. Volatility on the downside isn't that big of a deal because it's limited to a $0 payoff. Okay, so that's a counterintuitive idea that you like volatility in these cases where you can have flexibility. Sometimes you'll see options broken into kind of three types. All of these have the same ingredients that we've been talking about. In each type, there's still going to be uncertainty about how a project's going to play out, and there's still going to be the ability to change your actions depending on how that uncertainty gets resolved. But sometimes it gets broken into three pieces, and these are the kind of three types that you may see. The first is the option to expand. The idea here is you invest a little bit in a project, and then if things turn out to be better than you expected, right, if demand is higher than what you initially thought, then you can ramp up your investment. Right? You expand. Right? If you're introducing a new product, maybe you start with just a pilot market. You introduce your market to kind of select subsamples of the population, focus groups, things like that. And then if it looks good, then you kind of gradually ramp it up and roll it out to the entire country. Okay. The flip side of that is the option to abandon. Now, if the project ends up with lower demand than you initially thought, then you can walk away, right? You can abandon it. You don't have to continue investing in a bad project. You just kind of scrap what you can, salvage what you can, and then walk away. Okay? Having the option to walk away is valuable for the same reasons that having the option to kind of expand is valuable. And then the third type is the option to wait and learn before investing. The idea here is that you learn, you get new information by waiting, and that lets you make better decisions. So instead of committing your investment today, putting the money into a project today, you wait, and if things look good, then you invest. If things don't look good, then you don't invest. Okay, so these are all very closely related to each other. We'll walk through an example of each of them. When you expand, you're making follow-on investments if things look good, right? So do that first project. That's going to give you some insights. It's going to allow you to expand. It doesn't force you to expand, right? These are all options. You don't have to do it. It's not an obligation, but you have the option to expand if things look good. We want to make sure that we include these follow-on projects in the analysis. Okay? If we don't include that, then we're missing something, and our valuation is going to be incorrect. So let's do a little example of the option to expand. So suppose you learn of a new chemical treatment that causes water to freeze at 100 degrees Fahrenheit rather than the usual 32 degrees. Okay, so what could you do with this? Well, one application would be an ice hotel. If you've ever seen these, they're mostly in Scandinavia. You get these hotels where the walls are all ice and you live in a room with ice. But because of this treatment, it's not freezing cold, the water can stay frozen at a higher temperature, at a more comfortable temperature, rather than the freezing point. Okay, so you think maybe this is a good idea. I'm going to build these ice hotels, are novel, going to get some customers. Your baseline estimates are that you'll generate $2 million in perpetuity, starting in 1 year. Okay, so this is just a normal perpetuity of $2 million. And you have to put in an initial investment of $12 million today. So that's the cost, $12 million, and you get a $2 million perpetuity. With R equal to 20%, what's the NPV from this project? It's going to be the minus 12 that you put in today, plus the perpetuity of $2 forever. That gives us a NPV of minus 2 million. Okay, so the NPV rule says this is a bad deal, don't take it. However, things are going to change if we are allowed to incorporate options. So let's see how that would work. Let's introduce the first ingredient for any option problem. That ingredient is uncertainty. We said that you expect there to be a $2 million cash flow, but you're not sure it's going to be $2 million. 50% of the time, you'll get $3 million in perpetuity, again, starting in 1 year. Okay. And then 50% of the time, you get $1 million in perpetuity. Okay, so what are you expecting? Well, the average of 3 million and 1 million is 2 million. Okay, so if you do the standard analysis, you calculate the NPV in both cases, right? The NPV in the good state is going to be 3 million, put in 12 million, get a perpetuity of 3, that's worth $3 million in NPV terms. In the bad state, it's going to be minus 7 million, minus $12 million initial investment, plus a 1 million perpetuity, that works out to minus 7. Okay, so on average, half the time you get 3, half the time you get minus 7, so that's still minus 2 million. So it still looks like a bad deal. So what is this stuff about the option to expand? Well, we need to think about the second ingredient for any real option. First ingredient is uncertainty. We've worked through that. Well, the second ingredient is that you have to change your actions depending on how things end up. Okay, so let's introduce that. Suppose that you learn whether the thing will be successful immediately after putting in that initial 12 million. So you build that first ice hotel, you spend $12 million, and then you see how many customers are kind of knocking on your door. You open up your online reservation system or whatever, and you see very quickly how many people are willing to pay money to stay at the hotel. How does that affect your next decision. Okay. How are you going to use this option to expand? Well, if things look good, then what you're going to do is you're going to build more hotels, right? You expand. You build, say, 9 more in every major city in Scandinavia. So how does that affect your NPV? Let's pull up a whiteboard here. Okay. If things are good, then you get an NPV of 3 million. If things are bad, you get an NPV of minus, what do we say? Minus 7 million. If we're in this good state, what we're going to do is we're going to build 10 hotels instead of just the 1 hotel. Okay, so let's draw out kind of a typical decision tree. We said that decision trees are a very helpful way to structure our thoughts for real options because they summarize the uncertainty and how our decisions change in the face of that uncertainty. So what happens today is you're putting in $12 million. Okay. And then what happens in the future? Well, that depends. Depends on if things look good or bad. Okay, you draw a little tree like this, little arrows. 50% of the time we go one way, 50% of the time we go another way. Right? 50% is just, in this example, it could be, it could be different probabilities. In the review session we did on Monday, it was different probabilities. But for here, we just said 50% things look good, 50% things look bad. So in the top case, things are good. Let's put that up here. We get $3 million in perpetuity. That gives us an NPV of 3 million for each hotel. So if we build 10 hotels, right after you put in the $12 million, you learn if things are good, you just multiply that by 10. You get a positive $30 million now in NPV because you expanded. Right, you started off with this 3, but you decide, okay, I'm going to build 10 more, or 9 more to bring the total to 10. That gives me an NPV of 30 when things look good. If things look bad, however, half the time things do look bad, and you only get $1 million in perpetuity. So the NPV here we saw was minus 7. So if the NPV is minus 7, then you definitely do not want to build more hotels. Right? You just build that one, and that's it. Okay, so putting it all together, what are we left with? Okay, so this is, when I say you draw a decision tree, it's going to look like this. Right? So you draw out the arrows with the probabilities, and importantly, the NPVs kind of along each node of the tree. With the probability tree, you then work backwards to figure out whether you should invest in the first project or not. Okay, so how can we do that? Let's put that together here. Putting it all together and making a decision. What's the expected NPV from this thing? Well, half the time, things look very good, and you get an NPV of 30. So 50% of the time, you get 30, and then 50% of the time, you get minus 7. Okay, because you just build 1 bad hotel versus 10 good hotels. And what you'll see is this becomes a positive NPV. It's 15 minus 3.5, so we get 11.5 in NPV. So if the optimistic case turns out to be correct, we expand, we build a lot of hotels, and we make a lot of NPV from all of those hotels. And in fact, that's the entire value of the project. Right? The value is not coming from one hotel. That first hotel that you build, it's a loser, right? The expected NPV is negative. It's a -2. The entire value from that first hotel then is because you learn. It lets you know whether the market can sustain 10 more hotels. And if it can, then you're going to clean up and make a lot of money. So the entire value from that initial hotel is in the option to expand, not necessarily in the hotel itself. It's just you need to invest initially to learn whether it will work or not. Okay, that's what you're doing when you build that first hotel. So if you hit it big, you can score large, and you don't know unless you try. So that's why you have to put down the initial 12 million for that first hotel. And obviously, you can think of lots of situations where this is going to become important. Anytime that you're introducing a new product, you don't roll it out to all 10 cities right away, right? You roll it out in small doses to see how things go, and then you expand later. It's just like research, right? You do a little bit of research, see if it works, and if it does, then you ramp it up. Otherwise, don't bother, don't spend more money on it. The standard NPV analysis is not going to do very well here, right? The standard NPV analysis is you're just going to take your best guess as to what's going to happen and make a decision based on that. But here, things are going to change a lot depending on how things get resolved. Okay. So that's the option to expand. The flip side of that is the option to abandon. Okay. You're going to shut it down if things don't work out. You don't have to run poorly performing projects. Just because you don't want to be a quitter, you don't have to keep spending money on it. That's not how we make decisions in finance. We make decisions based on money, on returns. So just because you happen to hit a loser, you don't have to keep chasing it. You can close things down, get some salvage value out of it. That's going to be worth more than running a bad project. Okay. So the punchline here is, remember, sometimes projects are worth more dead than alive.
Sometimes dead is better.
Sometimes dead is better. That's, of course, the punchline from Stephen King's most horrifying book, Pet Sematary. I won't tell you about the plot, but it's been made into a movie a couple times now, and that's very much a representative punchline. Sometimes dead is better. The same is true in finance. Let's do an example to see how that works. So we're going to go back to the oil market. You're going to drill an oil well. The rig costs $300 today. And in 1 year, you learn that it's either a success or a failure. Okay, so there's that first ingredient again. There's uncertainty. We're going to say that the outcomes are equally likely, 50-50, just to kind of keep the numbers easy to calculate in our head. We have a discount rate of 10%. If things are successful, then the time one value of everything going forward is 575. So we're just collapsing everything into one number. That 575 is the success. Okay. If things are a failure, then at time one, all those cash flows are worth nothing. Okay, everything going forward is worth nothing. So let's draw out a decision tree like we did before. So for part A of any kind of problem, you want to calculate the standard NPV analysis, right? This is all the data. So let's do what we've always done at the very beginning of class. Let's calculate what we expect the NPV to be. Well, let's draw that out here. So what did we do when we learned about expected values? Well, we said we have to calculate the expected cash flow. You put in $300 today, and then you have to calculate the expected cash flow of what happens at time one. So half the time it's going to be a success, and you get the 575. Then the other half of the time, things are a failure, and you get nothing out of it. Okay. And that all occurs 1 year in the future. With a discount rate of 10%, we're left with the following. Okay, this would be our NPV. You calculate that, what's half of 575 discounted by 1, and you get an NPV of minus 3864. This should be familiar, just an expected cash flow, throw it into an NPV calculation. Our baseline analysis would be, this is a bad project, negative NPV, don't take it. Let's introduce the second ingredient to any real option problem. Let's say you can change your actions depending on how things end up. So suppose that if things look bad, you can salvage the rig for $250. at time 1. So salvaging the rig is going to be very different than operating the well, right? If you drill and you try to extract oil out of it, that's a very different plan of action than if you're just going to scrap things, sell the rig, and then get whatever you can out of it. Right? You bought it for $300. If things look bad, say you're going to try to sell it and for about $250. So you'll lose some money on it, but you can still get some money back out of the project. How's that going to change our decision? Well, let's draw the tree just like we did before. Right? We're sitting here at time 0. We have to decide whether to drill or to not drill. And obviously, if you don't drill, you just get nothing. That's all. If you buy the drill, you have to spend $300 today. Okay. What happens next? Well, you drill and either it's a success and you get that present value of $575 that's sitting at time 1. And this happens half of the time if you drill. The other half of the time, things are a failure. Our decision is not quite done yet. We still need to figure out what do we do in this failed state. You could, like our baseline suggested, you could stick to the plan, right? I'm not going to quit. I'm going to do what I plan to do. I'm going to just sit on that rig and stare at this empty hole with no oil. Okay. What's the present value of that? Well, we said that's 0. Right? You're not going to get any value from a failed drill. The alternative, though, is that you can abandon. Right? You don't have to stick to the original plan. You can change things. If you sell the rig, you can get the $250 back. Okay, it's not the entire $300, but you can at least get $250 back at time 1. So how are we going to work through this problem? Well, we have to work backwards. So what are we going to do if we end up at this node? We drilled and it was a failure. Well, we could have 0 or we could have 250. Obviously, we're going to have 250. What happens if it's a success? Well, we could get that 575, or we could, theoretically, we could salvage the rig and take the 250 back, but obviously we don't want to do that. Okay, so if things are a success, we're going to keep that 575. If things are a failure, we're going to just shut it down, abandon, and collect the 250. Okay, so we have to decide if that is a good deal now. Are we willing to put in $300 today if those are the two outcomes? Okay, so let's see how that changes our NPV analysis from before. What changes? Well, you still have to put in $300 for the rig. In a successful state, you still get 575. But if things fail, instead of getting 0, now you get 250. Okay, and that happens at time 1. So we'll see that changes the NPV, considerably. Now the NPV goes up to $75 instead of minus 38. So now we want to buy the rig. We want to drill. Before we did not. The entire value came from replacing a 0, a dud, with something, with 250. Okay. And in fact, if you want to see this number another way, how did we go from minus 38.64 to 75? Well, very precisely, if you draw out the tree, you can see by looking at which cash flow changes. Which cash flow changed? Well, it was at 250. You get 250 instead of 0, and that happens at time 1. Okay, that's how much your cash flows went up when you had the option to abandon. How much is that going to work out to? Well, we know exactly how much it's going to work out to. It's going to be the difference between the $75 that you calculated when you had the option to abandon and the minus $38.64 if you couldn't abandon. This negative $38.64 assumed that you were going to drill no matter what, and you couldn't sell the rig. If you can abandon and you can sell the rig, you get a 75. So the difference then becomes the value of the option to walk away. Okay, that works out to about $113.64. Okay, This is how much the ability to salvage the rig and walk away from it is worth to us, 113.64. And again, this is pretty important in oil and gas. Again, I'm not an expert here, but my understanding is that it's not so easy just to kind of turn the valve on and off for these drills, and so optionality becomes very important and can add a lot of value for them. Okay, so yeah, this is just working out the cash flows. If you can sell, you get 412 at time 1, so that works out to $75 kind of in NPV. And this is generally the formula for an option. In this case, we were able to compare the NPV if we can't walk away with the NPV if we can to get 113. But more generally, if you want to think about how much is an option worth, well, intuitively, you can value the project with an option, and you can value a project without the option, and the difference is the value of the option, right? So you can value things with the option, you subtract from that the value of the project without the option. There we go. What are you left with is the value of the option. The last type of option I want to talk about is the option to wait. You delay things, you don't commit right away. That gives you more information, and that more information lets you make a better decision. So you don't always have to commit to things right away. Sometimes you wait, see how things work, and then make a better decision. If things look more favorable than what you initially thought, then you can go through the project. Otherwise, you can avoid the project, and you can avoid paying those startup costs. Okay. So let's do an example of that. In this case, there's a building, a microchip plant that's going to cost you $14 million to invest today. Half the time, the market for those new chips will be strong, and half the time, the market will be weak. Okay, so there's that first ingredient that we've seen over and over again. There's got to be some uncertainty. Let's get a fresh page here. So there's some uncertainty here. You put in 14, sometimes it'd be good, sometimes bad. In 1 year, the plant will generate cash flows of 20 million if things look good, and 4 million in a weak market. So it's just one cash flow, or two cash flows, a time 0 cash flow and a time 1 cash flow. $14 million at time 0. Maybe you get $20 million at time 1. Maybe you get $4 million at time 1. That's it. Okay. We have a discount rate of 10%. Should you invest in this? Well, what would be the standard NPV? We're just going to calculate the expected cash flow that we'll get at time 1. You put in $14 million today, and what do we expect to happen in a year? Half the time we get 20. The other half the time we get 4, and that occurs 1 year in the future. So in expectation, you're going to get 12 in a year. And obviously, if you put in $14 today and you get $12 in a year, that's going to be a bad investment. So should you invest, well, you'll get a negative $3 million. So do not invest. Okay, so you see the pattern now. Every time we do the standard NPV, we get a bad answer, and we're going to introduce an option and turn it into a good project. Okay, so let's introduce that second ingredient. Now you're going to change your actions depending on whether things look good or not. So suppose that when you wait a year, you'll determine whether you're in the strong market, which is going to generate a cash flow of $20 in a year, or the weak market, which is going to generate a cash flow of 4. What are you going to do? Well, you have to work through the tree, right? You have to decide, should I invest if things are strong? Should I invest if things are weak? If you know that you're in the weak market, your NPV is going to be minus 14 plus 4 divided by 1.1. That's minus 10. Okay, so that's kind of an obvious bad deal. However, if things are strong, you put in $14 and you get 20 back a year later. So that's an NPV of 4.18. Okay, so in this case, if you know that you're in the strong market, you want to invest. If you know that you're in the weak market, you're not going to invest, right? This is that second ingredient. You're going to do something different depending on if things look good or not, and that's going to affect our valuation. So let's put this together into a decision tree. Down for now. Okay, so this is everything that we had discussed. Just put it into a tree. Suppose you don't do anything today. So if you do something today, you know that you're going to get this -3. That was the standard NPV analysis. We didn't know what was going to happen. In expectation, we get a -3. What happens if we wait? Well, today we're waiting, so we're not doing anything. Okay. Then at time 1, we learn whether we're in the strong market or the weak market. Again, both happen with probability 50%. If we're in the strong market, we get a positive NPV of 4.18. If we're in the weak market, we saw that we get a -10.36 NPV. So we're not going to invest here. We're going to get a 0, which is a lot better than -10. Okay. Once we have the tree set up like this, we just have to walk backwards. We move from time 1 to time 0 to see how much the project is worth to us, incorporating the option. So what happens at time 1? Let's insert another text box here so that we can put it all together. What's our expected NPV at time 1? Half of the time we get the 4.18 if it's a strong market, and the other half of the time we get 0. We decide not to invest at time 1. Okay, so that works out to 2.09. That's what we get at time 1. We got to work backwards and figure out what the value is of that at time 0. So at time 0, we have to discount that value that we got at time 1 by 1 time. So we get that 2.09 discounted once, which is equal to 1.9. So this is the NPV of the project if we can wait. It's positive, right? Where we want to wait and see what happens, and then maybe we'll invest if things look good. Okay, so that's all summarized here. There is a downside to this option to wait. So on one hand, it looks unambiguously good because we were able to avoid this -$10. It's not always going to be valuable, though. The option to wait has a counteracting effect, and that's that you have to wait. Right, so there's a time value of money component here. That's why we're discounting this 2.09 by 1.1. We're discounting at 10% because you had to wait. Okay, so I want to reiterate that the option to wait isn't necessarily always good. It's trading off two things. Okay. There's two things going on when you're waiting and learning. The first, which is kind of intuitive, is that you learn and you make better decisions. That helps your valuation. However, the second effect is that you have to wait. That means that the time value of money kicks in, and those future cash flows are worth less to you. So it's possible that waiting is more expensive than the information that you get, right? It's possible that by waiting, you learn a little bit, but you don't learn that much. And the cost of waiting is more than the benefit of making a better decision, right? That's perfectly possible. Okay, so we want to make sure that we're familiar with this, and we know that it's not always better just to wait and wait and wait and wait. Obviously, at some point, the cost of waiting can counteract the benefits. In this case, we created that 1.9 in value simply by waiting and learning if things were good or bad. Okay. Next, we'll do an example with many different scenarios. We'll see that Excel is going to help us when we've got a lot of different stuff going on. Now, we're still going to draw out a tree, but Excel is kind of a nice, Excel allows us to calculate many different scenarios at once and help us kind of collect our thoughts in an organized way. In this example, you have to make an initial investment of $15 million today. It's kind of typical. You have an initial investment, and then things happen in the future. So at time 1, you'll have to invest in a production facility at time T1, and you'll also earn revenues at T1. So just to be very simple, all of this happens at one moment in time, T1. There's uncertainty, though. Just like all of our examples, we have this first ingredient for any real option problem, uncertainty. We don't know exactly how much the production facility will cost to make, right? It could be low. Maybe it's only 40 million. It could be middle, 80 million, or high, 120. Okay, so our costs have some randomness, and likewise our revenues are random. We could have low revenues of 50 million, could have high revenues of 130. All of this is happening. It gets resolved at time 1. Each of these scenarios are equally likely. So how many total scenarios do we have? Well, we have 3 possible costs, 2 possible revenues. So you multiply those together, you get 6 possible combinations. You could have low costs and low revenues. You could have low costs and high revenues, middle costs, low revenues, middle costs, high revenues, etc. Okay, we're going to put all this together and value the project, assuming a discount rate of 10%. Okay, and again, keeping it very simple, these are the cash flows. There's nothing else going on. We have this 15 today, and then some scenario combining these revenues and costs together at time 1. Okay, so let's put all of this together in a spreadsheet that's going to help us summarize kind of all that data in one place. So I've already done that here. We've got these 6 different scenarios, which are based on the combinations of revenues and costs. Okay. We put the revenues and the costs together to get the total cash flow at time 1. Okay, so in the good state of the world, you have high revenues and low costs, so you would have a cash flow of $90 at time 1. In the worst state, you have low revenues of 50 and high costs of 120, so you have a negative $70 cash flow at time 1. Next, I want to calculate the NPV of each individual scenario. The cash flow is minus 15 today for every scenario we've seen, but the randomness occurs at time 1. So let's see what the NPV is for each. You have that initial cash flow, and then you have a cash flow at time 1, which you discount at 10%. So if we have low revenues and low costs, we have a negative NPV of negative 5.91. Okay, you do that for every scenario to get the entire range. What would we do in the first 2 weeks of class when we want to calculate the expected NPV here? Well, we've got different scenarios. We calculate the weighted average. Right? With some probability, we're going to be in this top scenario 1. With some probability, we're going to be in scenario 5. With some probability, scenario 6. Okay? We would take each of those probabilities, multiply them by the NPV of each outcome, and then take the sum to get the expected NPV. We're going to do the same thing here. It's a little bit easier because we assume that everything is equally likely, so we can just take an average. Each of these 6 scenarios is equally likely to happen. That gives us an average NPV of minus 5.91. Essentially, on average, we're expecting to get $10 at time 1. You can see that here if you highlight all of the cash flows at time 1. You see the average is 10. So with a $10 cash flow at time 1, we have a negative 5.91 NPV for the entire project. Standard analysis says don't take it. It's bad expected NPV. Pass. It's all laid out here in the spreadsheet. But let's suppose we have an option to wait and learn. We'll push everything back a year. But by doing so, we'll learn which scenario we're in. Okay, so you don't have to invest at time 0 anymore. Instead, we're going to invest at time 1 if we decide to invest. That's going to push back the building of the production facility. So the revenues and the costs from that are going to be pushed back 1 year, from time 1 to time 2. What that gives us then is not an NPV anymore, but it's going to give us a time 1 value, not a present value, but like a net time 1 value, if you will. So instead of a net present value, we'll get a net time 1 value. We're just pushing everything back 1 time. See if I can make that a little smaller. So what does that buy us? If we wait and we're sitting at time 1, when are we going to choose to invest? Well, we know which scenario we're in. We know what the costs and the revenues are going to be if we invest. So are we going to do it if the value sitting at time 1 is negative 5.91? No, we're not going to invest at all at time 1. We're going to pass and say we're going to replace this negative number with a 0. And in fact, we'll replace all of the negative numbers with a 0 because you know going in that it will be a bad deal. So you replace all of these things with 0. Well, now with scenario 4, now we have a positive value of 66. So we're going to keep that. We want to invest if we know that the revenues will be high and the costs will be low, right? That's a perfect time to invest. So we're going to keep that value there. We're going to keep the positive 30 if we have high revenues and medium costs. We keep that. But if we have high revenues and high costs, that's negative NPV, so we're going to drop that. Okay. So what's the weighted average outcome now? Well, we have 6 outcomes still, but 4 of them are 0. We average all 6 of them together to get 16.21. That's now what we would expect to get at time 1. Note, though, that we waited. By pushing everything back, this is a time 1 value. So this is a lot better than what we had before. Before we had a negative number, now it's positive. But this is still 1 year in the future because we waited. So we have to then bring that back to today to get the NPV of the project. So we're going to take the time 1 value and discount it 1 time to get an NPV of about 15. So that's a net present value. That's the value today from this project if we wait and then figure out what happens before deciding whether to invest. Okay, so that's all laid out here in this table. We get $67 at time 1, but then we have to discount that to time 0 to get $61 in present value terms, $28 in present value terms. The average present value then is 15. Okay. By waiting and learning, we've avoided all of the negative outcomes, kind of like at the very beginning of this lecture when we talked about the price of oil. You can strategically choose not to drill if the price of oil is too low and you're not going to make money, and you want to replace all those negative numbers with a 0. We're doing the same thing here. That's going to increase our NPV from a negative number to a positive 15, even after we discounted stuff. Everything got pushed back into the future, so we had to discount things to bring it back to the present. Even after we did that, though, the present value is still positive. That again allows us to calculate the value of this option to wait. If you are able to wait, you've created about 21 in value. Your NPV is now 15. Before it was a negative 6. So that delta, that increase of 21 is the option value, how much that is worth to you. That's all the examples for real options I wanted to talk about today. I want to summarize and give you the basic steps because every problem we've done has followed these steps. Every exam problem has these steps. So I want to, in one place, summarize it. Typically, for part A of a problem, we'll calculate the value of the project ignoring options. Okay. So like the quiz problem for this week is like this too. You calculate it doing what we would normally do. You calculate the expected value of it if you're just sticking to the plan. You know, come hell or high water, you just stick to the plan. What's the NPV? That's usually part A of the problem. Then we have to draw out the decision tree, right? We've introduced some uncertainty, and we know that we're going to make different decisions along different nodes of that tree. So you draw out the tree, and you decide, you figure out what are you going to do at each point in the tree. So for example, a typical exam problem, you'll see there are two nodes, could be a good or bad outcome. So part B of an exam problem would be, well, if things look good, what do you do? What action do you take, and what is the resulting NPV? Part C of a problem would be, well, if things look bad, what do you do, and what is the resulting NPV? So generally, for an option to have value, you have to do something different if things look good than if things look bad. Right? If you do the same thing no matter what, if you just stick to the plan, then you're all the way back in part A. Right? You're just sticking to the plan blindly. So your value is not going to be any different than part A. The option has value if you're changing your actions depending on which state of the world you find yourself. Okay, so that would be part B and part C of a problem. Find out the NPV along each node of the tree. And then the third, or the fourth part, I guess, of a problem would be to weight these two outcomes. So you decide what is the value of the project if I have this optionality. If I can change when things look good versus when things look bad, what's the total value of the project? To do that, you're going to bring both of these outcomes from 2A and 2B. You bring both of those back to the present, and you weight them based on their probability, right? With some probability, you're in part B. With some probability, you're in part C. You calculate the weighted average of those to get the present value, the value of the project with that option attached to it. Okay, so you weight the outcomes from step 2 to determine the NPV, including the real option. And then finally, we'll generally subtract the answer to question 1 from the answer to question 3 to give us the value of the option. How much is the option worth? How much is the option to expand, or the option to abandon, or the option to wait and see? How much is that worth to us? How do you calculate that? Well, you figure out what the value of the project is when you have the option, and you already know what the value of the project is if you didn't have the option and you just stuck to your original plan. So the difference is going to be the value of that option. We pull back this survey when a couple academics sent out a survey to all of the CFOs. Remember, we asked them, what tools do you use? What methods do you use to value projects? Real options makes a decent showing of about 25%. It definitely depends on the industry, though. So in areas where there's a lot of volatility, oil and gas, pharmaceuticals, things like that, you're going to see real options. But it's becoming more more common generally. So key takeaways, when we include these options to expand, abandon, or wait, we see that the valuation can change a lot. Right? In all of our kind of silly examples today, we had a base case where the NPV was bad, but once we allow for an option, the NPV turned positive. Okay? So this is becoming increasingly common to do. We should understand the intuition behind this, and we should understand how to incorporate this with a relatively simple decision tree. We should be able to walk through these steps for problems to see how the option affects our decisions and how it affects the value of the project.